So Andy, people talk about diversifying your portfolio and how important that is. What is your take on that?
So diversifying needs to be done first and foremost because we want to spread the risk. I think often when people think about stock market investing, for many people, it's a case of buying shares in a single company. So I've got shares from Marks and Spencer's. They might look at Marks and Spencer's and say it's a very reputable brand, high street brand. Our money's safe, but actually putting your eggs in one basket. If something goes pear-shaped with Marks and Spencer's, IT issue, bad publicity, your money's in quite a dangerous position. So when we're building portfolios for clients' money, we take a very much a global approach. Mm-hmm. Broadly speaking, you're kind of spreading your money across the 6,000 biggest companies across the world. So that means you've got access to every different sector and access to every different geographical location. If I'm to use the cheesy example from the textbooks, you've got the ice cream salesman against the umbrella salesman. Depending on the weather, one's going to do better than the other. So we're trying to spread the risk, which should hopefully see smoother returns. Now, we are, of course, influenced by what's happening in the global market, so that's something we cannot control. But specifically for my clients, it comes down to what their objectives are. And when it comes to investing money, the principle is the longer the time horizon of the investment, the more risk you can afford to take. In our world, when we're talking about risk, it's about looking at equity content within a portfolio. So we use multi-asset investments for the majority of our clients, again, depending on their circumstances. So
multi-asset.
Yeah. So
what does that mean?
Yeah, let me elaborate. So typically it's a combination of equities and bonds in a portfolio. So if it was a portfolio which was 100% equity, this is investing in global stock markets, that would be deemed an adventurous risk investment. If it was one which was only 20% equity and the other 80% in bonds, we would deem that to be cautious risk.
Right.
Because the bonds, you're not expected to shoot the lights out. It's the equity which is going to get the growth. For me, when I'm building a client portfolio, I look at what their objectives are. Now, let me give an example. You've got someone who's perhaps approaching retirement age. They've got a bit of money stored in their pensions. They're looking to go into flexi access drawdown, which is withdrawing a flexible income to meet their expenditure. The approach I like to take is to try and calculate how much income we think the client might need over the next 5 years from the portfolio. In my example, let's say they need £20,000 a year. I like to take an approach whereby I segment the first 5 years, so £100,000 into a cautious risk investment. So that might be 80% bonds, 20% equity. The reason we do that is because I don't want the stock market doing this when they're pulling money out. You should find that a cautious fund returns are relatively smooth.
Right.
And because we've earmarked the first 5 years worth of income, we can take a slightly longer term view to the rest of the portfolio.
Okay.
Now, depends how comfortable clients are with investment risk. It might be that we have the bulk of it perhaps in a balanced risk portfolio, maybe a little bit in adventurous. Again, how comfortable the client is. What that allows us to do is when we do have the good years of growth, we can shave off some of the growth in the balanced risk and keep replenishing that 5-year pot. So we're not de-risking the entire portfolio because therefore you're missing out on growth, but we're taking a structured approach of segmenting 5 years, which allows us to be a bit more adventurous with the rest. And the long-term result of that is the money should last longer.
Okay. That's a very interesting approach. Sophisticated. I like it.